Welcome to Wise Beyond Bitcoin, your home for the crypto neo, news, education, and opportunities. My name is Ryan.
My name is Lucas, and welcome to another episode where we're giving you the latest and greatest. Of course, we've got playlists to give you up to date. If you like to learn about blockchain and crypto, here you go. We've got walk you through DeFi tutorials. We talk about airdrops, opportunities, innovation, how to get involved in the communities, how to stake, participate, vote. But we also like to talk about, how blockchain and crypto is changing the game in the economy and how the economy affects crypto, because it's just an emerging market. None of this is financial advice or commercial advice or legal advice, just financial entertainment. It's educational information. It's our research, and it's a new technology. So yeah, it's definitely, would you say, the tail and not the dog, or maybe even a flea on the dog in the world of finance and the markets at large at this stage? It's definitely still young and early, but
yes,
that's why it's important to look at what's going on in the world at large and what to expect in the future with the economy. And I hopefully after this video, you'll have a little bit better understanding. These are topics we've been talking about for a long time. In fact, we've been kind of signaling the consolidation and correction and this downturn in the market since before the end of the year. And we're going to continue to share that perspective as it unfolds, because it's economics, it's not rocket science, and the writing's on the wall. So let's read the writing and explain what's being written and what they're saying.
Right, that's good. Well said. So we have an article from Reuters, a Fed president from the Cleveland Fed, Miss Loretta Mester. She's making the call that it's going to take 2 years for the central bank to get inflation to its target of 2%. That 2% on the CPI, and that from here to there, it'll be a gradual moving downward from the current level. So the takeaway is that inflation is becoming anchored. It's obviously worse than what the policymakers initially thought, and they maybe, I think, arguably took too long to start pulling the stimulus back. Right, so it's now becoming clear that it's going to take longer than expected to deal with this, and it's going to take more, probably more higher rate hikes, larger number, and a greater percentage than what was initially thought. And yeah, that's the big headline.
And like sticky prices, a lot of the effects of interest rates that are being raised, the effects they have on the job market and the economy, it takes time. So just because we've seen the market recently, correct and deflate with the announcements of these rate hikes, a lot of the effects of these rate hikes have not even yet really proliferated and rippled out in the market. So the message here is that the Fed, they've been explaining that they're going to have to raise rates for quite some time. Well, what does that mean? If they're telling us right now that we're going to take a long, gradual year to 2 years of raising interest rates, what's that going to do? What's the effect that's going to have on the traditional market, much less the crypto market?
Well, I mean, from historical perspective, it is definitely bearish. I mean, you can go back to the last few rate hikes we've had. There two big ones that jump out are they came right before the top in the .com bubble, and then another one signaled the top of the housing bubble. So in around 2000 and around 2007, there was a similar move to hiking rates around the same target levels that we're talking about now. So historically speaking, this is how bubbles unwind, right? Bubbles are formed when money is pumped into the system, pumped into the economy, and that usually means lower rates. And then these bubbles are unwound when the money's pulled out of the economy and rates go up. So it's a bit of a breathing in and out. And the expectation is that if we're going to be constricting credit, raising rates over the next 2 years or 1 to 2 years, that prices on all things will probably start to come down.
Yeah, so that's a good point. And that's one of the reasons why we've been, if you've followed this channel or if you listened to one of our outlooks, it's that the blockchain and crypto market, as much fun as it is, as innovative as it is mostly fueled by institutional money at this point. BlackRock, Citadel, hedge funds, Three Arrows Capital, Michael Saylor's. You look at heads of governments purchasing large amounts of Bitcoin. The reality is that the crypto market is absolutely mostly fueled by traditional, institutional money. So if we see an unwinding and the music stops for musical chairs in traditional markets, we're going to see a lot of that unwinding and pulling out of blockchain and crypto. And we've already witnessed that. Now, that being said, I would not be surprised if at some point over this time, we see somewhat of a decoupling where you see certain blockchains, certain applications, certain technologies that have value built, that evolve and develop, that of something of use. We will see like the Amazons or the Googles or the Yahoos, or the AOLs. We very well could see, especially with regulation and other laws happening, other things happening at the same time. As you mentioned, it's not ceteris paribus in the system, the market, or the, what's that, not the scape, the landscape. Yeah, the landscape
Context.
the context, the landscape that we're in today is a lot different when you look at publicly traded companies like Coinbase, or I'm not sure if they are Gemini, Kraken, these other intermediaries that are registered, giving access to commercial banks or to other people, retail, pardon me, not retail, institutional access to these new asset classes. And I feel that even when they deflate, there's going to be a time when other people want to come in and pick up the pennies. Yeah. And pick up the good deal. But until then,
there's whale buying happening right now with Bitcoin to that point.
Sure. I mean, at some point, how low, you're already getting close to the bottom of the trough. Even when you look at this being something that plays out over time, you're still getting into a good place. Now,
we do expect things to go lower, broadly speaking.
Absolutely. Yeah. So do your own research and absolutely be willing to watch things go down with the ship if you do. But I look at it as tuition. If you dollar cost average or understand that this could continue to go down over time and you pace yourself, it's a good time to learn and participate, to get involved in the new technology. It's like, you can get involved in working with an email address or a phone app early. Right. And find out where the value
I wanted to highlight this one passage because it's a good example of the kind of Fed doublespeak that people are, tend to focus on. What are they saying? What do they mean? And there's so much meaning that's, that turns on the use of certain words. And there's a whole industry of people who follow these terms and specifically like what certain changes of phrases mean, and try to divine all that, right? Like read the tea leaves. And I think in this case, there's not a whole lot of divination required. It's pretty on its face what's being said, and this predicting some slowing of growth, right? Ticking up of unemployment and a reduction in below trend of growth of activity in the economy. That's what the Fed is expecting, and that's kind of what they're trying to do on purpose, right? That's the whole idea of fighting inflation is, you're pulling out some demand out of the economy, and that's going to reduce economic activity and create unemployment, and that's the price we pay, to get inflation under control. So I just want to highlight that. It's because clearly they're setting the narrative for us to expect slowdown in growth. Now, whether or not that is a recession, whether or not that slowdown meets the definition of a recession, I guess that'll be a question we'll answer and as time goes on. But clearly it sounds like a recession. Slowing below trend, unemployment going up. I mean, these are textbook terms and concepts that you would, use to describe a recession. So, but yet there's also no prediction of a recession. So it's a little, it's like, well, is it or not? Is it or is it not? What are you saying? But I just wanted to highlight that there is definitely a narrative there that to expect to slow down. And further, this is something other people have focused on a lot, this use of the term unconditional to describe the Fed's commitment to getting inflation under control. That clearly says that, you know, we are going to we're aware of the problems that's going to come with tightening in terms of, you know, unemployment and in slowing down the economy, but yet the commitment remains unconditional. So I don't think it gets any more clear really from the Fed in terms of guidance. I mean, it's really pretty on its face, you know, expect a slowdown, and this is something we're going to put up with, and we're going to tolerate it to get inflation under control. So yeah, I take all that together, and I'm hearing, you know, get into cash, stay out of financial markets for the time being.
Right. Absolutely. And now something else to mention is, and we have a video coming out on this, and we've talked about it before, but this is just covering the Fed and the Fed's role in the fight against inflation. There are other ways to provide relief to the market and the economy at large. We've been talking about it, and other people are talking about it as well. And that is reducing tariffs, tariff reduction.
Yes.
And, you know, so.
And we're going to do a video on that. On its own, so we'll
before we leave this, we will talk about that. Go back to that article real quick, because another thing I was going to mention about the landscape. So I was talking about the crypto landscape being different for a decoupling, possibly at some point during this bear market or during this time period. But you know, talking about a different landscape, a lot of articles come out and say, oh, the highest rate of inflation, or the most basis points being raised since 1994, since, you know, 1980, or all these metrics being thrown out. But the reality is the rate of inflation, the wiggle room that the Fed had back then to raise rates was a lot different than the landscape that exists today, the wiggle room today. So another reason why we mentioned tariffs and other solutions is because how much and why are there limitations, really?
Yeah, well, that's worth talking about. So the last time this was a big problem was, like you said, the 80s, and we had that we were coming out of that stagflation period, and inflation was, I think, double digits for a period. You know, it was really bad. And so the Volcker Fed made it their mission to get this under control. And they, at one point, had rates as high as 20%. So they were really stepping on the brakes of the economy and destroying credit and money pretty fast. And it had the result of, you know, breaking the inflation problem. It put us into a recession at the beginning of the 80s that didn't last very long. So it wasn't, you know, it wasn't anything too catastrophic. But it still, it kind of was the high water mark of what a disciplined Fed could do at that time. And the reason people point to that is, you know, as something to bring up and be aware of, is that our inflation problem is, for the first time, is about on par with what it was during that period. But the difference is that the Fed no longer has the room to bring rates as high as what Volcker did. And it's because of how much debt the Treasury has. And if at the debt levels we're at today, if you were to get rates anywhere near where Volcker had them, we'd be talking about paying interest on the interest payments on the debt would just balloon. And so you're talking about just the interest would cost more than almost the entire tax revenue of the Treasury. So it'd be kind of like a bankrupting moment for the Treasury. They would have all these liabilities and payments they would have to make, but they wouldn't have the revenue to do it with. And the problem would be is that it would be an interest payment that would just be insane. And so that's kind of the difference now, is that the Volcker Fed didn't have to deal with that. That wasn't something they were dealing with. So that's one way the context is different. And that means that if the Fed can't act in a similar way as it did to fight the inflation problem in the 70s, then maybe we have to start looking at other tools. And we can talk about that in a later video. But yeah, that's the segue.
If you like this kind of stuff, you know what to do. Subscribe, notification bell, drop a comment. We love the love. So keep it going. And until the next time, have a beautiful day, and namaste, y'all.
Thank you.